Your financial future depends on understanding one critical economic shift that's happening right now. The Bank of Canada's latest monetary policy report reveals how U.S. tariffs aren't just affecting trade. They're forcing Canadian businesses to reconfigure their supply chains and shift workers between sectors. Companies are diversifying away from U.S. dependence, but this transition is costing them more money and keeping unemployment elevated at 6.8%. Meanwhile, inflation appears controlled at 2.4%, but temporary factors are masking underlying pressures that will affect your costs for months ahead. The question every Canadian should ask is, how do I position myself during this economic transition? The answer starts with understanding how these changes connect to create effects you might not expect. We will be running down the Bank of Canada's monetary policy report today. Instead of reading a 44-page report, I'll sum it up in about 10 minutes. Hi. Kane again. I'm a starving artist that graduated from theater school about 20 years ago. Today I own properties throughout Ontario. Be sure to watch my video to see my story. Also check the link in the description for references. If there are any discrepancies, please let me know. Moreover, the information presented in this video is for educational purposes only. Please consult a professional if you are going to invest. Without further ado, let's get started. U.S. tariffs and heightened uncertainty have created what economists call a trade shock system. Most people think tariffs just make things more expensive. They miss how trade shocks create a domino effect through the entire economy. The 4% drop in Canadian exports represents thousands of jobs and entire supply chains being disrupted. While politicians debate tariff policy, Canadian businesses are quietly making decisions that will reshape your job market for years. Companies that relied on U.S. trade routes are scrambling to find new suppliers and customers. This process costs significantly more than their old arrangements. A manufacturing company that produced auto sector components for U.S. assembly plants now pays extra to source materials from European suppliers and find new buyers. A logistics firm that moved goods between Toronto and Chicago now searches for contracts with Asian markets. Each new relationship requires months of negotiations and higher upfront costs. The ripple effect hits hardest in manufacturing and logistics sectors. 80% of import declines are concentrated in tariff-affected industries. Workers in these sectors face reduced hours and hiring freezes. Companies wait to see if trade relationships stabilize before making major staffing decisions. For example, a factory worker who worked overtime last year now gets 35 hours per week. A truck driver who hauled goods across the border now competes for fewer domestic routes, part of the transportation subsectors that employ 8% of Canada's workforce and rely heavily on U.S. exports. This uncertainty creates a feedback loop. Businesses delay expansion plans, keeping unemployment elevated even when other economic indicators look stable. The system is rewiring itself, moving away from decades of U.S.-Canada integration toward a more diversified but expensive trade network. A small manufacturer that sold exclusively to U.S. retailers now spends months developing relationships with buyers in Mexico and Europe. The process works, but profit margins shrink. Your job security now depends on whether your industry can adapt to this new trade reality. Sectors tied to U.S. markets face the biggest challenges. If you work in automotive parts, food processing, or cross-border logistics, your employer is likely restructuring operations. Companies are finding new markets, but the transition takes time and costs money. Workers in these industries should prepare for continued uncertainty as businesses navigate higher costs and longer supply chains. This trade shock reveals why understanding economic systems matters more than tracking individual indicators. The numbers tell you exports dropped 4%. The system shows you why your job prospects depend on your industry's ability to adapt to permanent changes in North American trade relationships. But there's another system creating confusion about your financial future. The Bank of Canada reports inflation at 2.4%, which sounds manageable. Base year effects from last winter's GST and HST holiday are creating misleading readings about your future costs. That tax break you enjoyed over the holidays will distort inflation statistics for months. The real drivers of inflation continue pushing your expenses higher every month. Food prices remain elevated in categories like fruits and vegetables, meat and seafood, and bakery products from supply chain disruptions and higher transportation costs. Tariff costs add to the price of imported goods as companies pay more for products from new suppliers. Your morning coffee costs more because the beans travel longer routes to avoid tariff-affected trade channels. Core inflation measures like CPI trim and CPI median hover around 2.5%. These measures reveal the underlying pressure that won't disappear with statistical effects. They strip out volatile items and show the persistent upward trend in basic costs. Housing, services, and processed foods all continue rising at rates above the headline number. Lower energy prices provide relief at the gas pump, with oil prices assumed at $60 Brent. Brent is a benchmark to measure crude oil. Mortgage interest costs are also easing slightly. These factors get offset by higher costs for imported goods as companies pay more to source from non-US suppliers. Your heating bill might be lower, but your phone, clothing, and household items cost more. The savings from cheaper gas disappear when you shop for anything manufactured outside Canada. In April, inflation is expected to settle just above 2% because the removal of the consumer carbon tax from 12 months prior stops having a downward effect on year-over-year figures. This creates another layer of statistical complexity that masks the true cost pressures you face. Understanding these effects helps you prepare for higher costs instead of being misled by temporary statistical improvements. The February and March numbers may provide false comfort before underlying pressures return. This inflation confusion connects to another economic system that's trapping workers in a cycle they don't recognize. Labor market slack reveals why 6.8% unemployment feels worse than the number suggests. Despite 190,000 new jobs created since August, job vacancies have fallen to their lowest level since October 2017. This creates excess supply in the labor market that keeps wages low and advancement opportunities scarce. Companies are hiring just enough people to maintain operations. They avoid the investments that create higher-paying positions. For example, a restaurant may hire servers, but delays promoting anyone to management. A warehouse may add part-time workers, but puts off creating supervisor roles. Businesses fill basic positions while avoiding commitments to career development. Youth unemployment remains high because entry-level positions in trade-dependent industries have disappeared. The Business Outlook survey shows hiring intentions remain weak, which explains why companies cut costs by eliminating training programs and junior roles. A manufacturing plant that used to hire apprentices now asks experienced workers to take on extra duties. A logistics company that trained new drivers now requires 5 years of experience for entry-level positions. Wage growth has converged below 3%, while unit labor costs remain modest. This sounds reasonable until you realize it barely keeps up with actual living costs in major cities. Your salary might increase by 2.8%, but your rent goes up 4% and groceries cost more. The math may work against you even when you get a raise. The soft labor market creates a cycle that reinforces itself. Weak hiring intentions lead to cautious consumer spending. This reduces business confidence even further. Workers spend less because they worry about job security. Businesses see lower sales and become more reluctant to hire. Businesses report they are waiting for trade policy clarity before making significant hiring decisions. This leaves workers stuck in a holding pattern. A marketing professional applies for better positions, but companies delay filling roles. A skilled tradesperson waits for construction projects that depend on trade agreements. This labor market system traps people between jobs that do not pay enough and opportunities that do not exist yet. You need higher income but cannot find positions that offer it. Companies need workers but will not invest in roles that might become unnecessary if trade policies change. Career advancement may require switching to sectors less dependent on U.S. trade. Healthcare, education, and domestic services offer more stability than manufacturing or logistics. Understanding these labor market dynamics helps you make strategic moves instead of waiting for conditions to improve. The key is positioning your finances to navigate this extended period of economic uncertainty. Building a defense system starts with understanding how the nominal neutral interest rate range of 2.25 to 3.25% affects your financial options during this transition period. Lower interest rates help with borrowing costs, but the economic restructuring creates new risks that most people are not preparing for. While mortgage costs ease, property values in Toronto and Vancouver remain disconnected from local incomes. Rate cuts cannot solve affordability challenges when a house costs 10 times the median salary. Your mortgage payment might drop by $300 per month, but you still cannot afford the down payment on an average home. The math does not work even with cheaper borrowing costs. The approach requires balancing three elements. You need to protect against inflation, maintain liquidity during job market uncertainty, and position for eventual recovery. Your savings account should hold 6 months of expenses instead of the usual 3 months. Job security is weaker now, so you need more cash available. At the same time, inflation eats away at cash holdings, so you cannot keep everything in savings accounts. Traditional investment returns will be lower than historical averages. Stock market gains that averaged higher returns might deliver lower performance during this transition. Bond yields stay low as the economy restructures. Real estate appreciation slows outside major urban centers. The Canada-United States-Mexico Agreement Review, also known as CUSMA, represents the biggest wild card. The agreement could receive a 16-year extension, face significant renegotiation with stricter rules of origin, or default to annual reviews if no agreement is reached. An unfavorable outcome would significantly lower Canada's GDP path because nearly all Canadian exports are CUSMA compliant. Your investment portfolio faces risks from trade policy changes. Canadian stocks tied to U.S. markets could drop significantly if trade agreements fail. Proper positioning means reducing exposure to U.S.-dependent sectors that represent 8% of total employment, including manufacturing, transportation, and commodities like energy and forestry. Buy shares in businesses that serve domestic markets or export to diverse countries. Keep cash ready for opportunities that emerge as the economy restructures. Companies with strong balance sheets will acquire weaker competitors at discounted prices. Your financial survival depends on adapting to a new normal of slower growth, persistent uncertainty, and gradual economic rebalancing. These interconnected systems of trade, employment, and inflation are reshaping everything. Canada is transitioning toward a more fragmented world where geopolitical risks are elevated. By understanding these connections gives you the power to adapt instead of just react. Your job market depends on how well your industry can find new customers outside the United States. Your cost of living will keep rising even when government statistics show temporary relief. Position yourself in jobs and industries that benefit from trade diversification. Build financial buffers for the transition period. While growth remains modest and the bank expects it will be sufficient to gradually absorb excess supply over the 2026-2027 timeline, prepare for a fundamentally different economic landscape where uncertainty remains high. The transition will succeed, but your financial security depends on whether you prepare for the changes happening now. If you've enjoyed this content, be sure to watch my next video on how creating these three entities will better protect your family from lawsuits.